Okay?
Yes, thank you.
Okay. Recording.
Thank you.
Just stop. Can I do a really brief pitch about JDCUS, like a minute? Sure. Okay, awesome.
Thank you.
Hey guys, can I just have your attention really quick?
Okay, I'll see you guys later.
By show of hands, how many people are not graduating this year and have at least 3 courses left? Good, awesome. So you remember back in January when Dan announced that we got back from JDCUS and we had our best year ever, and you guys were all very kind and clapped? Well, we're recruiting for the academic team again, and taxation happens to be one of the disciplines, and it's also one of the disciplines that Dan, he has coached for the last several years, and we have done very well in. We've placed 3 out of the last 5 years in taxation. So if you're interested at all in trying out for the team, there's sign-up booths upstairs. Make sure you sign up for an interview, a case tryout, and then go to our Facebook event page and fill out a survey. And if you have any questions about it, I'll stick around after class and you can ask me then. Thank you.
It's actually fun. It actually is. It's not one of those lame announcements. It's like,
Oh no, it's actually the best time
actually
ever.
worth it.
So this is going to be a fun chapter.
Yeah. It's almost as fun as chapter 13.
Okay. Now we're talking.
It's not bad if you watch the video. I'm all about the videos. That's my
Yeah, did you hear that? Oh, you weren't here. Josh said those videos are amazing.
The videos are
Watch
fantastic.
chapter
I watch,
13
like, I know every time you cough in the video. It's like, I have it like all
The videos are getting around 30 to 40 views per video.
and 28 of them are minutes.
It's all credit to Cindy.
Thank you for letting us do that.
Yes, it's great.
Don't they?
They do not
Property and their
Really?
Because nobody knows the secrets of the tax code.
my textbook, I've got everything.
I'm sure you do. Chapter 17. Has anybody ever had any contact with a trust? Have you ever been a beneficiary of a trust, or do you know anything about it?
When my father died, it goes into a trust when you die, and then they just pay the inheritance out of there and wind up the trust when the assets are all disposed of, then the trust.
So your father died,
Yeah.
so he left a will, right?
Yeah.
And then, was your mother still alive at that time?
Yep.
So then the will said, this goes to this person, this goes in
And
to my wife and all the rest.
yeah,
How long did it sort of take to get sorted out?
about 2 years.
Who was the executor?
His accountant and his lawyer. Oh, my mother might have been one of them. Yeah, I think she was in there too. I think it was a try thing.
Gotcha. Was it a good process, or was there, I don't want to get personal, but
It was very long, and I think my mother was surprised by how long it took. But he had a lot of stuff, so I
Okay.
guess that impacts it.
So a trust is when, you may have heard the expression, somebody puts money in trust for somebody. So, in fact, I'm going to write that on the board also. Someone puts money in trust for somebody. So, your father put his estate, so all his assets, in trust. That means that he left them for somebody else to look after. For your mother and beneficiaries and maybe sometimes charities, children, yeah. So these are all the players. There's the person who set this up. We call that settling the trust. That's another one of those old English expressions. So the person, the father in this case, is the settlor. Meaning one who settles. He settled onto the trust his property in trust for somebody to look after. Those people were his executors, also called trustees. We call them executors usually in a deceased person situation, but trustees for somebody, and we call that the beneficiaries. And I think the best example of this is an estate. Similarly, I lost my father a few years ago, and I was the executor. So I wasn't the beneficiary. My mother was, and it was my job to be this person to sort of look after things, to make sure they all got to her properly, and I had to visit banks and those types of people. So I had all my father's assets in trust until such time as I could disperse them to my mother. Luckily, in that case, it took 2 months and not 2 years, but my dad had sort of knew he was going to die and was able to arrange a few things beforehand. We call this a testamentary trust. You've heard of the expression last will and testament? A trust arising on a person's death is called a testamentary trust. There's only 2 kinds of trust that you need to know about. One is testamentary, so that happens on death. The other type happens during a person's lifetime. The Latin phrase for that is inter vivos, which is in the textbook. Vivos, you may have heard of the expression like Viva Las Vegas. Vivos means life. So testamentary trust and an inter vivos trust.
Does inter vivos refer to when it's created?
No. Because by definition, even your father's trust and my father's was created while they were living, right? Because they wrote out their will.
Oh.
But the testamentary trust sort of comes to life itself after death. So it is not inter vivos. In fact, it's a creature of the testament, his last will and testament. That's why it's called testamentary.
So inter vivos means then that it's happening while the settler is still alive.
Indeed, and the settler actually gets to see sort of how it all plays out, which is fascinating and which I'll talk about close to the end of tonight.
Okay. Does it convert if the...
No, once a trust is an inter vivos trust, it continues to be an inter vivos trust even after the death of the settler.
Thank you.
So once an inter vivos trust, always an inter vivos trust.
Okay.
Page 632, the tax treatment of trusts. Way back in chapter, 2, I think, we listed who was all the taxpayers. So you got an individual and a corporation and blah, blah, blah. And a trust, if you can remember that far back, was one of them. In fact, those are the only 3 taxpayers I know of: an individual, a corporation, and a trust. So unlike a partnership, a trust files a real tax return and pays real taxes. The fiscal year end for a testamentary trust is usually the anniversary of the death. So if I die on April 4th, on the way home, I hope not, the anniversary date would be April 4th, 2014. That's when the fiscal and taxation year end would be of my testamentary trust. An inter vivos trust always has a December 31st year end. That December 31st year end should give you a hint that maybe a trust will be somewhat similar to an individual, and that's true. Page 633. A trust pays tax at the same rate as an individual. But a testamentary trust pays tax at the highest individual taxation rate. In our ongoing examples, 45%. I beg your pardon. An inter vivos trust pays tax at 45%, so the highest tax bracket. A testamentary trust, blessedly, pays tax at progressive marginal rates, so they start at 15% federal and et cetera. So you can see the, on page 633, the chart in the middle is the tax rates that apply to an inter vivos trust. In fact, if you wrote inter vivos trust there, you'd be doing yourself a favor. And then on the bottom there is the tax rates for a testamentary trust. If you wrote testamentary trust, you'd be doing yourself a favor. Please flip the page to page 634, because you're probably thinking, well, what tax credits do we get against this? And the answer is, if you look at the third full paragraph, the one that says, when calculating tax for inter vivos and testamentary trusts, blah, 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 no personal tax credits. Just stuff like foreign tax credits, dividend tax credits, that type of stuff, but no like basic spousal, medical, all those types of things. As you might expect, a trust's tax return is actually pretty straightforward. So typically, it's property income, because I said before, usually what's happening is the settlor is putting property in trust. So here we're usually talking about interest and dividends and that type of thing, capital gains. So we don't have all kinds of like business capital cost allowance, employment income calculations, that type of thing. And then all we do is apply the right tax rate and we're done.
What if though, there was an asset that went in, say it was a company? Then,
Well, that's shares, right? So we
yeah.
might get dividends on the shares.
Oh, okay, so you're saying it would still be taxed on its own little thing and then,
That's right.
okay.
Let me ask you a question back. What if instead of being in a company, the business is owned by a proprietor, and the proprietor dies, the proprietor's business does come into the trust, and now we might have business income and a calculation of business income.
Okay, so it's possible but not likely.
Possible, but very rare, because frankly, most people run their businesses through corporations.
Okay.
Everybody okay so far? Page 634 at the top. A trust deducts the income that it pays to beneficiaries. We call that a distribution. This is kind of unusual because if you think of a corporation for a second, a corporation pays dividends. Dividends aren't deductible to the corporation that pays the dividend. We talked about partnerships. Partnerships don't get a deduction for cash that they pay out to partners. But a trust gets a deduction for income that it distributes, pays out, to its beneficiaries. So in this particular case, a trust had $60,000 worth of income one year, and it paid out $40,000 to its beneficiaries. So the trust pays tax on $20,000 income, either at progressive marginal rates if it's testamentary, or 45% if it's an inter vivos trust. And then each of the beneficiaries, who in this case are individuals, and that's usually how it works, each of the beneficiaries takes $20,000 into income from the trust. So the $60,000 actually got split three ways. It's income splitting, and it's completely legit. So a trustee is normally a person, hopefully a person, who understands a little bit about taxes, and depending on the situation, especially if the trustee is working for a testamentary trust, there might be some awesome income splitting opportunities here. Not so much if the trust is hanging on to 45% taxed income. That's not really good income splitting, nor planning. But to be able to hang on to $20,000 worth of income inside a testamentary trust, and that's all its income, pay tax at
15%.
15%.
I'll
And
make
it's
it
great.
go as high as 47,000 each, right? Well, because it's the first tax bracket, which is up to 42,707.
Correct.
So,
So yes, if this is the only income earned by any of these three taxpayers, they can swallow $126,000 worth of income, paying tax at the lowest rate. Plus the individuals would get the credits, right? Which the trust doesn't, but hey, that's life. So you can see how a testamentary trust, it might have been actually very good to keep that trust going for 2 years, which I guess it had to in any case to you know, distribute all the assets and stuff. Because the trustee, if he was a well, lawyer and an accountant,
Yeah.
were able then to retain some of that income inside the trust and be taxed on it at a fairly low rate. Yes.
I think you already answered it, but I guess the reason for the high tax rate is prevent someone from splitting income for themselves to lower their bracket.
Yes. If I set up a trust and made myself a beneficiary, then if it was progressive marginal rates for an inter vivos trust, I just cut my tax return in half and thereby lowered my rate. So that's indeed a very good reason why it's taxed at the high rate, to clearly discourage that.
I'm sure that singleton guy would try it though.
Later on page 634, it talks about income allocations and beneficiaries. And the point to that is that the trustee not only allocates the amount or distributes the amount of income out, if there's 2 or more types of income, he can actually choose that beneficiary A gets capital gains and beneficiary B gets dividends or whatever else there was. So the trustee can take into account the tax position of the beneficiary. Let's say, for example, the beneficiary's got huge net capital losses available. Okay, I'll fire the capital gains out to that beneficiary, pay no tax. And then the interest and dividend income can go elsewhere, just depending on who can best use it in their own tax return.
And the timing is discretionary based on the trustee too?
And the timing is discretionary as well. Trustee has a lot of power. Trustee can decide not only how much, but when, or not at all, to distribute income.
But it's a legal document, correct?
Yes.
So he can be bound by some restrictions based on how the trust has been legally worded?
That's right. So for example, in the case of, say, a will, often what a will say is my wife is the main beneficiary, and I insist, I as the settlor, say that 90% of the income of the trust each year has to be paid out to her. Or whatever percentage, and sometimes it's 100%. And in fact, in some cases it's 100%, but the assets stay there, so that the assets are there for the next generation after the wife dies. So if you have that type of restriction, yeah, the trustee is bound then to pay all of the income out to her, but the capital stays put. So the fruit goes to the wife and the tree stays in the trust. And then the testator or the settlor might have also said, I want the tree after my wife dies to go to children A or B or whomever.
So generally, I guess it would.
Does anybody else have any questions? Sorry.
I'll let you continue.
No, go ahead.
So generally, would a person writing up a testamentary trust legal document planning for their death, assuming that they had a number of assets, spend a great deal of time on determining all that stuff, as opposed to leaving that to the discretion of their trustee?
It depends. Some people really have a soft spot for their assets, especially if the assets are like a family business, for example. Like they really care sort of who gets that and under what circumstances and stuff. So they might put a lot of time and a lot of rules and stuff like that. Can I tell you a funny example? As you know, I have a car that I think is special, and in my will, it says that one of my kids should get it, but they should pay for it at fair market value. And every couple of years I change the fair market value in the will, because you know, the fair market value keeps going down, it's just a used car. And, but I say if there's a dispute, if two of them want it at that price, I have 3 kids, if 2 or more want it at that price, they have to pay 1 round of rock, paper, scissors to figure out who gets the car. That's the truth. And my lawyer said that's hilarious, but it works, and whatever.
You can do that?
Yeah.
Best 2 out of 3.
Yeah, so they practice every time I get on my bicycle and ride through rush hour traffic, they're practicing rock, paper, scissors.
I just really like that car. Maybe they're just like trying to make you feel good.
Maybe.
They're secretly saying, okay, I don't want that car, you say paper. Just kidding.
You were talking about assets and allocating and rules and stuff like that. This is one thing where it's like a blank canvas for the person, either the person who's writing the will or the person who's making up a trust, and they really get to put sort of a lot of their personal beliefs and feelings into it and stuff, and sometimes that gets translated into sort of the actions that are taken by the trustees. And a lot of trust is put into the trustees to make sure that the trustees are acting as the settlor prefers, and sometimes the settlor will actually even write a side letter that says, I know this is the legal stuff, but I'm writing you a letter to say what I really want to happen with these assets for these reasons and stuff like that. That's sort of more heartfelt, let's say, than what would go into an actual will or into a legal document.
So it has to be more than 2 types of income for it to be, like, to decide where it's gonna go to which beneficiary?
If there's only one type of income, the decision is only how much to give of that type to each beneficiary.
Okay.
If there are 2 types, I got 2 decisions, which beneficiary and what type of income they get.
So one beneficiary could receive both types of income just depending on the percentage?
Correct, that's
Okay.
right. The 21-year rule, page 634.
Are you going to discuss the treated equitably or not? It's not important.
I answered that question on the bulletin board.
Okay.
Enough said, I'll go on. In addition to the rule whereby inter vivos trust has to pay tax at 45%, which I would classify as an anti-avoidance rule, there's another one that says, we're not going to let this trust go on forever without paying tax on capital gains inside it. See, each of us, when we die, we have to pay tax on our assets at the time of death, except for a spousal rollover. I could set up an inter vivos trust, throw all my assets into it, and unlike me, a trust never dies. It stays around forever. Government said, every 21 years, we're going to make trusts deemed to sell all their assets and report a capital gain. Even if they don't actually sell them, even if they keep the assets, we will deem that they have sold them. So if my assets in 21 years are worth $100,000, which given my prowess at the stock market is probably what they'll be down to by that time, my trust would have a deemed disposition at $100,000 minus adjusted cost basis capital gain. And then its adjusted cost base going forward would be $100,000. 21-year rule just simply makes sure that there's a reckoning, let's call it, whereby capital gains tax gets paid approximately once a generation, even if the trust lasts forever.
And it's only in relation to the capital gains part.
It's only in relation to capital gains part. And it's just to allow the government to tax us, to tax a trust on its accumulated gains every once in a while. Now, I'm a trustee, and this trust is 20 years old, and there's a giant gain in it. Do I have any planning possibilities? The answer is yes. There are two types of beneficiaries. There's an income beneficiary and a capital beneficiary. So remember the example I gave earlier where I said, let's say a spouse earns the income inside the trust every year. In fact, the trustee in my example is bound to pay it to the spouse every year. So she's getting the fruit, but the tree stays in the trust, and the tree will be there for the children, let's say, after the wife dies. So in this case, the wife is an income beneficiary. She just gets income. The children are capital beneficiaries. They're entitled to the tree in my example. The trust is 20 years old, let's say, and the wife has passed away. So the tree is still there, available someday for the kids, and there is a giant capital gain on the tree. The beneficiary can distribute the tree, the capital of the trust, tax-free to the beneficiaries, and therefore work around the 21-year rule. And this is completely legitimate. And there's no capital gain on that. This is different from anything else we've taken, right? Like, for example, if you take an asset out of a corporation, if a shareholder takes an asset out of a corporation, that's a capital gain to the corporation. It's a deemed disposition for the corporation. We get, or capital beneficiaries that is, get to take assets out before the 21-year rule, and that is tax-free. So the way they...
Any answer?
any asset. Yeah. Which, yes?
So do they take out the entire tree? Like, or like how do, that's how they would have to be able to avoid the taxes. They would have to take out the entire tree.
Maybe just the
right?
branches that have accumulated gains.
Okay.
The trustee doesn't have to distribute all of it. If the trustee, according to the instructions he's been given by the settlor, says, no, I think it's important that I should hold on to some of the assets for a while. We've got some, say, GICs or near cash assets. There's never a capital gain on a GIC.
So it's not like one type of,
No.
okay.
So we can distribute the assets with capital gains and keep the others in the trust.
If you didn't want to remove any of the assets of the tree, could you, I don't know, deem a disposition every 5 years in order to spread out the gain, or is that possible?
No, that's a very good question, actually, but I don't think there's any mechanism to do that.
Was there any advantage to doing that, though? Because,
Well, you'd sort of smooth out the gain, I guess, and if it were a testamentary trust, you'd have some income splitting going on, but you'd also be prepaying your tax, and that in itself might be a disadvantage.
If you don't have any gains, do the losses become net capital losses going forward?
Yes, they are net capital losses of the trust, which is not necessarily a good thing. I mean, you cannot
It's a
distribute.
constant tax bracket too. It's also a constant tax bracket, so you'd want to take them earlier.
Correct.
And yeah, you can't distribute them back to the.
You cannot distribute a loss, you can only distribute income. So they just sit in the trust, and I've actually had some cases where trusts had net capital losses, and it was made people grouchy.
People ever roll the capital assets out and then just have the person sell it right back to them and like roll it back in?
I've never seen that. I'll get to a reason why that's not a good idea. Page 636, transactions with settlers and beneficiaries. This is the symbol for a trust. I don't know why it's this, but it is. So a trust distributing to a capital beneficiary is a rollover transaction. So there's no capital gain to the trust, and the beneficiary simply picks it up at the trust's old adjusted cost base.
now we're talking about transferring assets as opposed to allocating income?
Correct. Now we're talking about transferring assets as opposed to allocating income. Sure.
I know that the triangle is a trust or the part of the trust.
And that's the beneficiary. And in this example, the beneficiary is an individual, so they're a circle. And the trust is transferring, distributing an asset to the beneficiary. And that's a rollover, my squiggly line,
Okay.
which means it's not a taxable transaction, and the beneficiary picks it up at the trust sold adjusted cost base. So I mentioned that a capital beneficiary is a type that is entitled to get the tree. The other thing a capital beneficiary is entitled to is the retained earnings of the trust. So for example, in this earlier $60,000 deal on page 634, so the trust held on to $20,000. That becomes what's called, it adds to the capital of the trust. And if the trustee, say next year, pays some of that 20 out to the beneficiaries, that's tax-free to the beneficiaries. Because it's already been taxed once, it's been taxed inside the trust. So no further tax to pay. The beneficiaries can get that tax-free in the next year, but only for capital beneficiaries.
And you said that after-tax money has a name, specific name?
We just call it capital.
Oh, you just call it capital?
Yeah, you know, I think of it in terms like retained earnings, because I've always got corporations on the mind, but it's just really called capital.
Oh, okay.
Yep.
So when you say capital, you don't always mean a capital property.
No, it could be,
Here. Like in the instance you just gave me, your capital is now cash.
correct. So in this particular case, let's say that all of the retained earnings is represented by cash. But we just say that sort of in an accounting sense, it's capital. It's not necessarily a capital asset.
Thank you.
When we distribute that cash out of capital, tax-free to the capital beneficiaries.
Thank you.
Yes?
I was just gonna ask, if there was a beneficiary C in that example, and they're in a high tax bracket, could they essentially get tax-free income by waiting a year for their amount?
Everybody hear the question?
No?
So if, in this case, page 634, let's say that there's a third beneficiary, A, B, and C. So if there's a beneficiary C who didn't get the 20,000 and 20,000, and if the trustees have the discretion to just pay A and B one year and maybe C the next or something, and let's say that C is in the highest tax bracket. Unlike these folks where this is their only income, let's say that C is in the highest tax bracket. C can indeed receive $20,000 next year out of the capital, tax-free. So C's portion only bore tax, trust tax rates, rather than his 45% tax rates. So again, if the trustee is smart as to the beneficiary's tax position, allocating income types to one or the other is a neat way to save tax, and likewise paying capital out tax-free to, has to be a capital beneficiary the year after, because it's tax-free. Any other questions before I move on? So on stuff coming out of a trust, that's a rollover transaction. To answer Sam's question, there's no rollover for assets coming into a trust. So if we take this asset out, let's say, and then stick it back in, that's a capital gain to the beneficiary. Again, this is the opposite of everything we've talked about, right? Because a corporation, you can get a Section 85 rollover. And a partnership, you can get a, what section rollover?
97?
Section 97 rollover. There's no such thing for a trust.
Sorry, who pays the capital gain?
The beneficiary who sticks something into the trust. In this example, he got some low ACB capital out of the trust. He puts it back in, his ACB is still low, but it's a fair market value transaction with no, like Section 85.
Property decreased in value when they rolled it out for the 21 year. No, it couldn't be rolled.
Well, and if you're talking about moving assets into a trust, you're only talking about an inter vivos trust then, right? Because a testamentary trust, all the assets would go in on the date of the death, correct?
Well said. In a testamentary trust, all the assets go in once, date of death. So we're only talking about inter vivos trusts when we talk about putting something into the trust later.
Is that common in inter vivo trusts to move assets into it during a span of time?
No, not too common, for two reasons. First of all, there's no rollover. And second, some people think that creates a new and different trust.
Ah, some
Which-
people
which-
being CRA?
Yeah.
Hmm.
Or it can cause a problem with an existing trust somehow tainting it,
Oh,
where it wouldn't get certain tax advantages that are beyond the scope of this discussion.
okay,
But it's a good question.
thank you.
Spousal trust. I might like to set up a trust for my spouse. I'm the settlor, and I know that if I give her a gift, there'd be attribution back to me. Maybe I'll just put it in trust. Sorry, attribution still applies. So if the trust earns income, which gets paid out to her, the income is taxed in my hands, therefore not a good idea. In fact, now that I think of it, probably the income inside the trust, even if it is not distributed, probably comes into my hands. All you need to know is that the attribution rules work the same with a trust as opposed to making a gift to my spouse, my minor children. Just because I do it by way of a trust makes no difference. Income of a spouse gets attributed back to me, and income of a minor child on the gifted property also gets attributed back to me. Yes?
Can you have a spousal trust if you pass away? Like, can you create that? Or-
Excellent. In fact, that's an awesome spousal trust. For this reason, there is no attribution back to a dead person.
Okay.
So in fact, most spousal trusts are testamentary trusts whereby the spouse is the beneficiary. And all spousal trust means is that the spouse is the beneficiary. There is no attribution back to a dead person. Now I'd like to do a chart, and maybe you can help me fill it in. So I want to compare between a corporation. Well, I'll just do the symbol, right? What's this? Partnership and a trust. Is a corporation a taxpayer?
Yes.
Is a partnership a taxpayer? Is a trust a taxpayer?
Yes.
So far, so good. What do we call, so the person who owns these things or who has an interest, what do we call the income that an interest holder has from a corporation?
Dividends?
A dividend. And if I'm a shareholder, I'm taxable on a dividend on what basis? Cash basis or accrual basis? Yes, I'm only taxed on dividends that I receive from the company. I'm not taxed on the ongoing retained earnings. If the company pays no dividend, I pay no tax. Partnership. Cash basis or accrual basis? Accrual basis. I am taxed on the ongoing, on my percentage of the ongoing income of the partnership, even if none of it is distributed back to me. Trust. Accrual or cash?
Accrual.
The trust is taxed on accrual.
It depends.
Who are we
who's
talking
beneficiary.
about?
The interest holder, in this case the beneficiary, are they taxed on the accrual basis or the cash basis?
If they're capital, are they
They can
taxed
still
at
leave
all?
their cash in the, oh wait, this is a trust, never mind.
Depends whether or
On
not.
a cash,
Yeah.
on a.
Oh, a debate.
They're taxed on dispersion of, on allocation of assets, so that's a cash basis.
Unless they're counted beneficiary.
Got to use the word allocation very carefully because allocation is actually what's used to describe what happens in a partnership.
That's the word they use in chapter 17, allocation of
Distribution,
distribution,
yeah.
okay?
Yeah, that's what
On
it is.
distribution, so it's cash basis.
Cash basis is correct, yes.
But is it accrual in terms of the 21-year rule?
You could call it that, but that, I'm more interested in sort of what happens every year. But quite correct, as a, we use the word pregnant actually to describe gains like this that are sort of gestating. And as the gain gets more pregnant every year, you're quite right, it's sort of like on the accrual basis. But year to year, we actually are taxed on a cash basis. A beneficiary only pays tax on trust income that's been distributed to them.
Because that's income as opposed to his example, which is capital.
Correct. If you like, I'll make it more clear and call this annual income. Is there a rollover available to transfer property in?
For a corporation.
Yes, for a corporation.
Yes. What section?
85, 97. Actually, hold on.
No, the thought was no.
You can't roll into
Oh, no.
Rollover out?
it. 85, 68.
Bingo.
Or 67 or 69.
69 is correct,
Okay.
which means it has to be at fair market value. Therefore, there is no rollover of assets from a corporation to a shareholder. Partnership? None. A partnership which transfers assets to a partner has a capital gain or loss. Same as a corporation. Trust?
Yes.
Yes. Don't you just love that the tax system has these like really diverse sort of things that if you look at them from afar, they all seem the same, but actually they have some pretty different characteristics and therefore are useful for different things.
Which is good, because those are different entities.
Correct, they are different entities.
So it's nice that they don't treat them all the same.
Yeah.
So for a corporation, you can't do a rollover out,
Correct. When assets come out of a corporation,
fair market value.
fair market value. For section 69, as you correctly said. Now I want to tell you about the best trust I ever set up. And when I see my client, it's, "Hi, how are you?" And he says, "That was the best thing you ever did for me."
This is a tax thing. You don't really think of trust as tax specialty things.
You know, it's funny you say that because when you see this example, it's actually got nothing to do with tax.
Well,
It's just a thing, but there have to be tax rules because this thing earns income, so how do we, planning,
tax planning.
how do we tax? Like, there must be a return, and there is, so you just need rules for it because it's got income. But a trust itself is not usually a tax thing, done for tax reasons. Please bear with me. Please turn to page 567. At the top of the page is this diagram. Do you remember what this diagram is called? What this is an example of?
A reorganization? It's a reorganization?
It's a reorganization. It's got a sort of a slang name.
Freeze.
It's an estate freeze. So this is actually the case I spoke to you about, but I didn't give you all the details before.
Ooh, details.
So a gentleman owns a company worth $20 million at the time. This is about late 90s. He comes to the realization that even if the company should increase in value, and as I mentioned it did, it became worth $400 million, the $20 million would be enough because you can't take it with you, and if it increases much higher than that before his death and that of his wife, he wouldn't have the cash to pay the taxes on the capital gain because his adjusted cost base was probably $100 or something. And you know what's the tax on $20 million capital gain at 45% tax rate?
Quite a bit.
Can anybody do that math for me? 4.5 million. So either he has to buy life insurance for $4.5 million, or else they'd have to sell some shares or something, and none of that is palatable. So he decides that hopefully one of his two sons will have an interest and want to take over the business someday. But rather than just have them come in to the company, as happened here on page 567, he set up a trust instead. And the trust bought the new common shares for, I don't know, $1,000 or something nominal like that. And he replaced his common shares with preferred shares with a redemption value of $20 million. And we symbolize preferred shares with a broken line. So this is $20 million preferred shares. Why did he use a trust? Hint, his oldest son was 6 years old.
There's no capital gains, because they can roll it out, because they can roll out the capital assets.
He has 21 years to figure out how the kids turn out and which one of them, or both, or neither, take an interest in the business. He is right now about year 15. There's about 5 years to go. One of the kids is taking a commerce degree at Western, and things might turn out, and that kid might get a majority of these shares allocated to him, tax-free out of the trust. But the deal was that the father wanted 21 years to make up his mind and see how the kids turn out. That's the only reason.
So could he dissolve the trust without paying out any of those assets to those two beneficiaries? Is that an option if you set up the trust properly?
No, once a trust is set up, I mean, the assets they're not his assets.
Right.
So somebody, the trustees, have to do something with those assets. And their choices are keep them forever and pay capital gain tax on $380 million.
After the 21
We don't like that
years.
one, yeah. Or make a distribution sometime before the 21 years in what seems to be the right proportion given the interests of the children. And for example, if one kid gets all the shares, the father would do something else for the other son. Perhaps give him some of these shares or something like that. But the whole reason this was done actually had nothing to do with taxes. Well, it did by way of the father knowing that if he died, his estate only has to pay tax on $20 million, not on $400 million. So the estate freeze part of that was tax planning. But the trust is just to be able to allow him and the other trustees, there are other trustees, to buy time to figure out the right decision in distributing the shares out to the kids. Now, interestingly enough, the father is also a beneficiary of the trust. So if both kids turned out crappy, the father would just say, I'll take the shares back.
But then he'd be taxed at a huge rate because you can't do that, right?
In fact, what happened is that the father got somebody else to settle the trust. I think the trust was settled by his father or his father-in-law or somebody. Because if a settlor, now this part is beyond the course, I'm just telling you for interest's sake. If a settlor gets income from a trust or property, in this case shares coming out, there's a whacking huge bad tax result to the settlor. So somebody else actually settled the trust, which allowed the father to be a beneficiary and allowed the father to be a trustee. The part I want you to know about, and this is the important part, is just that the trust allowed the father up to 21 years of decision time, which is very handy in an estate-free situation, not knowing how the kids will turn out. It's also handy in an employment situation. For example, when I want to bring my employees in and I issue shares to them, we talked about that also in chapter 14. Because I don't know how the employees turn out. So then, rather than giving, say, 10 employees 10% apiece, I'll put the new common shares all in the trust and make my decision on a more informed basis after a few years go by, and I really know who my loyal and best valuable employees are. This for me was might have been the most rewarding thing I ever did as a tax person, because it satisfied his sort of personal needs. He was saving taxes or deferring taxes because on his death he'll only be subject to $20 million of capital gain. But it also helped him with a family decision to make about his most valuable asset, which is this company, and this company was started by his grandfather. And he really wants to make sure that it gets handled properly at the right time, and this trust helps him to do that. And he buys me lunch when we get together. I told you to exclude, among other things, on page 639, the use of commercial trusts. I still want you to exclude it. I just want to talk briefly what this means. Some business entities are set up as trusts. For example, RRSPs are usually trusts, just for your interest sake. RRSPs, of course, don't pay tax, so they're not quite the same kind of trust that we know about. Another type of trust is called a REIT, a real estate investment trust. There are a couple of significant REITs headquartered in Winnipeg, actually. Artis REIT is one, which have holdings of commercial property and residential property across the country. Real estate investment trust. So trusts aren't just sort of used for wills and inter-vivos trusts like this one was. There are also some trusts that are used in a commercial sense. I've just told you enough about that, and I'm just mentioning it for your interest. It is not anything that you need to know for the course. A couple of announcements. You've hopefully seen my email today about office hours. So by popular demand, these will happen not this weekend, but next weekend. So Friday the 12th and Saturday the 13th. And I know a couple of people have already signed up for a slot. Even if you don't sign up for a slot, I would really encourage you to come. I got 663 upstairs, which seats about 7 or 8 people comfortably. Just come and study if you want, and sort of hear the discussion and put up your hand once in a while. Whoever has signed up will get the floor, but as you know, I like to answer questions in between other people's questions, so I hope it's useful to you, and hopefully 6 hours will be helpful. I will, of course, be looking at the message boards, which is my preferred way of hearing your questions and giving answers so that other people can see them. But if you feel more comfortable sending me an email, that's fine. You can do that as well. Yes?
Is there some limit to the number of times we can sign up for a slot?
Yes, there is. As I just before class put a note on it that I would like only one slot per person, just because there are 24 slots and 50-some students. But again, I would invite you to come, even if you don't sign up for a slot, because you will, I promise you will be able to squeeze your questions in. It's just that the person who has signed up will have the floor during their time. Does anybody have any questions about anything? I'm going to hand out the student survey. As I said to you in my email earlier, I really find useful the comments that folks put on the back, especially if there's ideas on how to improve the course. I'm going to be outside because when you're done, if you want to grab me and bring me back in to ask some questions yet tonight, please do that. So I'm not going anyplace. If you have, for next Tuesday, any ideas of section 13 and 18, chapter 13 and 18 stuff you want me to cover, including a question that you're stumped on or a concept that's bothered you, please let me know that in advance.
How do you want us to let you know? You want to put up a bulletin board for it?
I will put up a bulletin board for it and I'll email that to you tomorrow morning. Any questions tonight? You have just come through one of the most difficult courses there are, and I'm looking forward to our review session and also seeing you at the final and also the office hours beforehand. Thanks.